Would you make a bet with me using some of your hard-earned money if you knew I had a 90% chance of winning and you only had a 10% chance? I'm guessing you wouldn't probably like that bet. Yet, if you're using actively managed mutual funds or ETFs, hoping that professionals will help you achieve better returns, that's essentially the kind of bet you're making. Oh, and if you're paying fees to a financial advisor who is placing you in actively managed funds, your chance of winning are probably even less than 10% in the long run. So let me explain. This isn't my opinion or up for speculation. It's backed by solid data. The SPIVA scorecard has been tracking the performance of actively managed mutual funds against their passively managed benchmarks for over 23 years. In addition, if you're using a financial advisor along with the actively managed funds, there's a good chance you're not even aware of all the fees you're paying or how those fees are impacting your portfolio's growth. By the end of this video, you'll have a complete understanding of how professionally managed funds, both mutual funds and ETFs, perform against simple index funds, and you'll learn how to identify the hidden fees you may not know about. I hope you take a quick moment to hit the like button and leave some comments and questions below. It really does help, and I do try and respond to every comment. Now, first of all, it's important to understand that an index fund can either be a type of mutual fund or an ETF. An ETF just stands for Exchange Traded Fund. Index funds are designed to replicate the performance of a specific financial index, such as the SP 500, Dow Jones Industrial Average, or NASDAQ Composite. Indices that many people are familiar with. They can also track groups of mid or small-sized companies, like the S&P Mid-Cap 400 or Russell 2000. There are even bond index funds, like the Bloomberg U.S. Aggregate Bond Index, which follows the total bond market. Investing in index funds is often called passive investing because these funds operate with minimal human intervention. Neither you nor a fund manager needs to research individual companies or handpick stocks based on their potential to try and outperform the market. This sets index funds apart from actively managed funds in a significant way. In an actively managed fund, the fund manager selects investments with the goal of trying to beat the market. An index fund doesn't aim to outperform the market. It simply wants to match its performance. Since index funds are passively managed, you generally pay lower fees than you would in an actively managed fund. As you might imagine, it costs more to have a team of people actively manage a fund. These fees include investment manager salaries, bonuses, employee benefits, office space, and marketing materials needed to attract new investors. All of these expenses are rolled into what's called the expense ratio. Actively managed funds tend to have higher expense ratios, which cut directly into the returns, causing many of them to underperform their passive benchmarks. So let's take a look at that SPIVA scorecard, which has extensive data on tracking the performance of actively managed funds against their specific passive benchmarks. Funds are grouped by categories such as large cap, mid cap, small cap, and so on to ensure the appropriate benchmark is used. In 2023, that year alone, 60% of actively managed funds underperformed their passive benchmarks. Even more telling, of the 40% that outperformed that year, only 20% continued to do so the following 3 years. According to Forbes, referencing the SPIVA report, no manager has consistently remained in the top 25% of all managers, let alone outperform the index for 5 consecutive years. In fact, only 1% managed to remain in the top half. In essence, managers who outperform today are highly unlikely to replicate that success in the future. In fact, check out this chart. and pay close attention to the last three columns, showing investments over 10, 15, and 20 years. We can say approximately 90% of all actively managed funds underperform their passive benchmarks over 10, 15, and 20-year periods. Much of this is due to the SPIVA report accounting for the increased fees they charge, while the rest is simply because it's very difficult for any manager or individual to consistently beat the market. And there's that bet I offered you at the beginning of the video. Remember when I asked you if you would make a bet with me knowing that you only had a 10% chance of winning? People are drawn to actively management with the hopes of outperforming the comparable market. However, the facts show that over 10, 15, and 20-year periods, actively managed funds have a 90% chance of doing worse and only a 10% chance of doing better than a similar passive index fund. Given those odds, I think I'd go with passive index funds. Many professional managers are skilled, but very few consistently outperform the market enough to justify their fees. But I doubt they want you to know that. And more people are becoming aware of these benefits of index investing. A mutual fund or an ETF can be structured as following a passive index or an actively managed fund. According to Morningstar research on net asset flows for the 12-month period ending June 30th of 2024, passive mutual funds and ETFs saw net investment inflows of over $650 billion, and actively managed mutual funds and ETFs saw net outflows of investments of over $350 billion. What makes these results even worse is if you're paying a financial advisor a fee, and then they place you into actively managed mutual funds or ETFs. According to the advisory headquarters, the average investment advisory fee varies depending on the portfolio balance. Here's a chart of the average fees charged based on the account balance. Let's take a look at an example of someone with a $500,000 portfolio. They would be paying $5,250 every single year in fees. But it actually gets worse than that. With an 8% growth rate, that $500,000 would grow into over $1,580,000 in 15 years with no additional contributions if you didn't have fees. However, after subtracting the annual 1.05% fee, it would only grow into about $1,360,000. That seemingly small fee of 1.05% just cost you $220,000 over 15 years. But that's just the annual fee on what's called assets under management, which you pay on the portfolio balance every year. You should also carefully review their detailed fee schedule. I recently checked the fee schedule at a very common place people go to seek a financial advisor, and they had additional fees on both types of IRAs, monthly fees on money market accounts, a 2% fee on reinvested dividends, a 2% fee on systematic stock purchases through dollar cost averaging, and other miscellaneous fees. And that might not be the end of it. If you hold mutual funds or ETFs in a portfolio, there may be some additional fees beyond the standard charges that you really need to be aware of. The biggest culprit to watch out for is what's called load fees. Load fees are charged on mutual funds to help compensate the broker who recommended the fund as an investment to their client. And they typically range from 3.75% all the way up to 5.75%. For example, Class A shares, also known as A shares, usually come with a front-load fee, which is a sales charge or commission you pay up front when you purchase the asset. Now, remember that over 10, 15, and 20-year periods, only about 10% of actively managed funds outperform their specific passive index fund. And that's without considering all these additional fees that a financial advisor and their firm may be charging you. Maybe that's why even Warren Buffett, one of the greatest investors of our time, recommended in his letter to shareholders that most investors would be better off using a low-cost S&P 500 index fund. In fact, he has said both large and small investors should stick with low-cost index funds. He even suggested 90% of the cash inherited by his family should be invested in such a fund. Now, this isn't to say that some advisors can't provide some good advice. However, if you're looking to get professional advice or input, many investors would be better off finding a fee-based advisor and paying them for a few hours of their time. After all, when I visit a doctor or have a lawyer draft a contract, I pay for their time, and that's it. I don't keep paying them a portion of my income for the rest of my life. According to the advisory headquarters, the average hourly fee charged by a fee-based advisor is about $120 to $300 per hour. Now, many advisors try and tell you that they can protect you more during the down markets. In the past 25 years, the two worst years in the market were 2002, when the S&P 500 dropped over 22%, and in 2008, when it dropped over 37%. Going back to the year 2016 SPIVA report, the 10-year snapshot would still include the 2008 period, and a 15-year snapshot would include both of those years. And when you take a look at this chart, you will see the results really are not any better. Look at the columns for the 10 and 15-year performance. Those numbers are the percentage of actively managed funds that did worse than their comparable passive index funds. Again, only around 10% of funds managed to beat their passive index fund benchmark. And if you're going through an advisor charging you their own fees, and then they place you into actively managed funds, well, good luck. I know for myself, I think I'll just avoid all those fees and have a 90% chance of winning.